liquidity, right? So this is the concept. I'm confident to say that 99.999% of the retail traders have completely no idea about their approach to liquidity, their understanding of liquidity. Everything is completely pretty much wrong, right? So I do teach some students on SMC. So the most people, they just consider liquidity as double bottom, triple bottom, so all those things, and trendline liquidity, right? So guys, first, in this video, I'll just explain what the basis of liquidity is in the market and how to use liquidity to trade in the market. So the first thing you should understand is stop labeling such things as liquidity. Of course, double bottom, you can call that liquidity. But what will you call an order block? It's nothing but liquidity, right? You are just naming that this point in the market is an order block. But in truth, behind the scenes in the market, this is nothing but just another type of liquidity that's present in the market. So it's just you as a human, you're just labeling all these things so that you can understand the market better. So first thing you should always keep in mind is you're not trying to understand the market structure, you're not trying to understand the order blocks, you're not trying to understand the fair value gaps. What you're trying to understand so that you can trade in the market is only liquidity in the market. So everything comes back to liquidity. So once you understand this properly, you have mastered trading, or at least you can be a profitable trader, right? Okay. So the first thing you should do is, let's say this is a typical structure in the market. We get a breakout structure right here, the market goes up. First, completely forget what time frame this is. This can happen in 15 minutes, 1 hour, 4 hour, 1 minute. It's completely up to you. It's about your trading style, right? So it's a random time frame, or it's applicable to every single time frame. So this is a typical structure. We get a breakout structure right here. So what does the market does after this? It usually comes down, right? After a breakout structure, for the market to go up, the market has to come down and mitigate the order blocks present in this structure. This is the simplest basic thing you should first understand before trading SMC. Okay, so I have marked 2 order blocks in this structure, as you can see. Which order block has the highest probability of giving you a winning trade? So pause the video and guess that for yourself. The answer is very, very simple. This order block, the first order block right here, this has the most chances to fail. So you should ingrain this in the back of your mind. Why is that order block in the middle has the highest chance to fail? The reason is very simple. If you see here, the market has accumulated a bit of liquidity in here, right? So why should the market just mitigate this order block and go up and break this structure? Why should the market do that while the market has already accumulated some liquidity present here, right? So this is liquidity. Why should the market follow this order block? This is the first commonsensical question the retail traders must ask themselves before going inside the trade. Before jumping into a trade, before placing limit entries like this, ask these questions to yourself. There is already liquidity present here. Why should the market follow this order block, right? So the chances that the order block will pass is very low. Let's say 50-50 or less than that. So you should not use limit entries for this order block. So what does the market do? It comes down, mitigates this liquidity and mitigates this order block, the extreme order block in this entire structure, and then the market goes up and breaks this high. So the reason is simple. The market took every single liquidity present in the structure in order to go up and break this high, right? So guys, this is the simple thing you should understand. Liquidity is not just double bottom, double top and all those things. Liquidity is present every single point in the market. You should keep on adapting and changing your trading style, your entry types, all those things in accordance with how the market accumulates its liquidity. So for example, to give you an example, let's just say that instead of this, the market took this high and then the market is coming down, right? So the market has swept this high and then the market is coming down, which means that the market has already hunted the liquidity present right here. So now this order block's chances of winning increases. So now can you take limit entry right here? Actually you can, but still there is some liquidity present here. So what can you do? Simple, just use different entry types. Use 1 minute confirmations. Use stop entries instead of limit entries. These are all the ways you should always actively adapt to the market situation. If your system, if your trading strategy is rigid, it's not at all flexible, then in the long term, I'll just say that the chances that you will be profitable is very, very, very low, right? You should always adapt to the market conditions. So this is how you should understand liquidity, guys. So first, stop labeling all these things as such and such. Just look at the market, what's happening currently in the market. Forget about all these market structure, all these things. Just mark your order blocks. Just look where all the market has accumulated liquidity, right? After you train your eyes to spot where the market has accumulated liquidity, you will know exactly where the market will move next. So you can join me Telegram. I always predict where the market will move next, and I'm accurate about 80% of the time. So how am I able to do that? Because I usually only stick to liquidity in the market. I don't look at order blocks, all those things, only liquidity in the market. So guys, I hope this cleared something about liquidity. So I hope you learned something. See you guys in the next one.